In any other era, a central bank raising or lowering its benchmark interest rate would be unremarkable beyond stock markets and policymakers. But the US economy has been through extraordinary times. First with the COVID-19 pandemic and the US Central Bank, the Federal Reserve, slashing its main interest rate to zero to ease conditions for consumers to get credit and for businesses to expand. But when pent-up demand began to soar in the wake of that pandemic, inflation started to spiral and the Fed was forced to raise its interest rates to the highest levels for years to drive down inflation. But the Fed has decided that battle is over now, with inflation close to the Fed's 2% target. And the Fed has decided it's time to cut that main interest rate. Here's the chair of the Fed, Jerome Powell.
In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a half percentage point to 4.75% to 5%.
But the size of that interest rate cut, a full 0.5%, will fuel concerns among some skeptics that the Fed has left it too late to cut that interest rate and is now acting aggressively to drive that rate down. And they point to certain numbers. Let's take a look at those. The unemployment rate here in the United States stands at 4.2%. Now, it did dip a bit in August, but it's been rising gradually. Also, hiring has slowed down. Both of these factors blamed on that benchmark interest rate by the Fed being so high for so long. And yet the GDP, the economic expansion of the US, is forecast to be around 2.6%. That's the forecast by the International Monetary Fund, which is optimistic about US growth. And it's worth noting that Powell says that 0.5% interest rate cut is a sign of confidence in the US economy, not a sign that things are going wrong. So what does this all mean for consumers in the United States, particularly those trying to get on the housing ladder with mortgages at the highest for years? Well, the Fed is thinking that it may continue to cut those interests, that benchmark interest rate gradually through 2025 until it reaches around about 3.5%. That's considered the level at which that rate neither hinders nor accelerates the US economy. So for mortgage lenders, well, they think that by the end of 2025, the average 30-year mortgage rate here in the US will be just under 6%. That's still relatively high compared to that real estate boom during the pandemic when those interest rates were low and you could get a property for around a 3% mortgage. Most insiders, most policymakers say don't expect mortgages to go back to that kind of rate anytime soon. Owen Fairclough, CGTN, Washington.